Welcome to another episode. My name's Jose Najarro, and today we are going to take a look at AMD's financial documents. So let's get started. So the first thing we're going to take a look at is the income statement. Here, the first thing is revenue. And we can see revenue does have this uptrend throughout the past quarter. So that's definitely a good news. We can see that last year's quarters were a little bit higher, but that's just because they had a little more demand last year. But overall, you can see, right, there's still this uptrend happening for revenue for AMD. So that's a big plus. Cost of revenue has kind of flatlined here in the 900 million range. So we have our gross profit has been increasing. Gross profit is the difference between revenue and cost of revenue. So here we can see our gross profit is pretty high right now, sitting at $621 million. And it's not that far off from where it was in those few quarters last year where they had really high revenue. So this right now is definitely a plus for me for AMD. So I'm going to start off giving a point to Bull Solo right off the bat up here. All right, so next I want to take a look at operating income, earnings before income taxes, and net income, and compare them to gross profit. In theory, all these incomes, I like them to have a very similar style compared to how they normally look like. And I want this because it means that they're either using the same amount of operating expenses, they're paying the same amount of taxes, and they're collecting about the same amount of money. So we can see operating income at beginning, it might look pretty different to gross profit, but if we just cut off the top tips of gross profit and glue them here, it would look exactly like operating income. So the only thing is this company is using a lot of money for operating expenses. And we can here see that operating expenses is a huge portion. It's about right now sitting at 562 million. And out of that, gross profit is 621. So we can see this company is using a lot of money for operating expense after its gross profit. So then we get this operating income sheet, which is just the difference between expenses and gross profit. And then after that, we take a look at all these other incomes, and they all look pretty much in line with what operating income looks like, right? We look at earnings before income taxes. It has the same style as it, and net income as well looks pretty similar. So that to me, everything is going pretty smooth, and the company is not doing anything fishy for the shareholders. So for that reason, I want to give this company again another point to Bull Solo. So the final thing I want to take a look at in income statement is the actual number of net income. So previously we were just looking at the difference between all the incomes, but now I want to take a look at net income itself. And we can see net income is at $35 million. That means this company made $35 million this quarter. Unfortunately, that's pretty low. That's almost flatline for such a big company. So this is a growth company. In my mind, I would consider AMD a growth company just because they have such a small share market compared to its competitors, Intel and Nvidia. But at the same time, this company is really barely making any money. So for that reason, I definitely don't want to give a point to Bull Solo at the moment. But this company at the same time is not losing any money. That Darth Bear does not deserve a point here, but it's something to take a look at, right? This is good to know that this company is pretty much flatlining with money, with net income. So next, we're going to take a look at the balance sheet. Here in the balance sheet, we can see the total assets and the total liabilities. For me, this is definitely my favorite sheet. So the first thing I want to take a look at is shareholder equity, which is the difference between assets and liability. And we can see right off the bat, this company has been increasing its assets and has also at the same time been decreasing its liability. And for that reason, we see this uptrend going on in the shareholder equity. And that is definitely a really good thing. And Bull Solo gets a point right there. So Bull Solo should be up at 3. He's definitely doing great. The force is strong with him. But hey, Darth Bear is just plotting his revenge of the Jedi and is gonna come back strong. Or is he? So now we're going to take a look at the asset distribution and liability distribution. So this is where we can see exactly how the company has distributed all of his assets and liability. The first thing I want to take a look at is this liability distribution. And one thing we saw is this company has been paying off this non-current debt over time, and that's pretty good. Right now, the non-current debt is sitting about $1.24 billion, and it's about 55% of its total liabilities. I did an episode previous to this, so definitely check it out, where I talk about how long this timeline is of when the next payment has to be done. This company has no current debt. It has no loans that it needs to pay off for 2019. It just paid off its final one this quarter, I believe. Yep, it paid off the final 70 million for this year. And right, current debt is debt that needs to be paid off within this year. Non-current debt is any debt that has longer than 12 months 12 months timeline to be paid. And I think the next one, if I recall correctly, like I said, check the previous episode, I think it's about 12 months, 2022, where this company has its next loan. Then we can see the next big portion of this company's liability is payables. So payables is what this company needs to pay to its suppliers, or anybody that supplies to AMD to create all these products. And one of them most likely would be TSM, which I think is TSM, the ones that create their wafers for their semiconductor devices. Next, we're going to take a look at their asset distribution, and their asset distribution are, again, it's pretty good. It's Next, we'll take a look at its asset distribution, and here we can see its asset distribution is spread out a little more with more items compared to liability. So the first thing I like to see here is cash and cash equivalents is sitting at $963 million. So what does this mean? This means this is amazing. I like to see this. So let's take a look at this. Cash and cash equivalents sitting at 963. Then we have current investments sitting at 165. Non-current investments sitting at 58 million. So about, this company has about, we can say, $1 billion and $1.1 billion of actual assets that this company can pull out really quick. So that almost gives me a 1-to-1 ratio to this non-current liability of the company. This company has a non-current debt of 1.24. So that's definitely a great thing. I like that the company has this much. This company can use all this cash to pay off all its current debt and non-current debt, and it'll be a business that'll be flat. And that's definitely a great thing to see. I mean, I would prefer that this company have zero debt and zero cash with it, opposed to a company that had so much debt and not enough cash to pay for it. So this is just worst case scenario, right? And I just want to think of it as worst case scenario. Then we can see receivables. This is the amount of money this company collects per quarter, either being some of its products might be paid off on a credit, so that's receivables. And we can see receivables is higher than payables. So this is what the company needs to pay off to its suppliers. This is what the company gets paid off by its customers. So that number again is higher. So this is looking pretty good in an asset distribution and liability distribution. The next thing is we can see this company has about $1 billion in inventory, and we see that inventory has not grown that much over the past quarters. So that's good to see. It means this company is definitely maintaining a flatline type of inventory, and it's not overproducing, because we don't see this ramp up in inventory assets. So to me, right, we have good asset distribution, we have great liability distribution, we have enough assets to pay off enough monetary assets to be able to pay off non-current debt, and we have enough receivables coming in to be pay off payables. So for that reason, Bull Solo, not Han Bull, Bull Solo gets 2 more points. I mean, Bull Solo here is running the game again, AMD. I definitely have to pick a stock next time where Darth Bear gets some love. But right now, Bull Solo is definitely doing great here. He's definitely taking all the points. All right, so next we're going to take a look at cash flow statement. And here in the cash flow statement, there's a few things I want to take a look at. Net cash flow from operations. So this is the positive cash flow that this company has from its everyday use, from its everyday operations. And right now this company has $30 million in net cash flow from operations. Just like net income, this company is barely flatting. But this is one thing, right? At least this company is not bleeding money this quarter. It did bleed some money previous quarter, and it does seem that it happens every first quarter for AMD. And this is something, right, that we can see has been happening. But just because it has been happening, it does not mean it should be happening. But here we can see this company is not burning any money this quarter. but it's not making enough money for me to even give a point to there. So there's no points going to be given for that. Then the next thing I want to take a look at is net cash flow from financing. So net cash flow from financing is negative, and that can only mean one thing. This company is either buying back shares or is paying its loans off. And we can see here from repayment of debt security that this company is actually paying off it's paying off its debt. This quarter it paid off the $70 million, and that's the final remaining portion that it had for its 2019 loan that we saw in the previous episode. But at the same time, it did seem to sell about $34 million of shares. So again, that's not a huge portion, and it's not something one likes to see, but 34 millions is not a huge amount of shares that they have had sold to collect money. So these could probably be like options sold to their CEOs, options, CEO plans, their big top dog plans. So again, it's not a huge portion of shares at the moment. So right here, we did not give any points to Bull Solo or to Darth Bear because right there, even though things are not looking perfectly good, they're not looking bad for Darth Bear to actually get a point. All right, so next we're going to continue to take a look at net cash flow. So here we're going to take a look at net cash flow from operations compared to revenue. So one thing I definitely want to take a look at is net cash flow from operations, and should always, in my mind, I want a company to have net cash flow from operations look pretty similar to both revenue, which should look pretty similar again to earnings per share. And the reason is if this company is selling revenue and the revenue is increasing, but you then have net cash flow from operations or even earnings per share being the opposite direction, it tells me that this company is leveraging too much money for it to, even though it's increasing in revenue, this company is not collecting, it's not having a positive cash flow. So here we can see net cash flow from operations versus revenue does have similarities, and for that that's definitely a great thing to see. All right, and now the second one, like I mentioned, the second one we want to take a look at is earnings per basic share versus net cash flow from operations per share. And again, these look pretty similar, just like revenue versus net cash from operations. And this is definitely what we would like to see. This means that if these look are pretty much identical, it means that this company is not doing anything fishy and it's not playing with numbers. And I know it's pretty hard to believe, but this happens on a frequent basis. Companies play with money, and it shows that they have a positive earnings per share, but at the same time, they are burning money like no tomorrow. One example that I just did recently is one of the big fangs, Netflix. Netflix reports a positive net earnings per share, but at the same time, its net cash from operations and its free cash flow is way off the charts. That company is burning money. But right now we can see AMD. So it's definitely good to know this. It's definitely good to check things like this out because it helps you see that this company is not doing anything weird. And because these two things look exactly like earnings per share, the net cash flow from operations looks similar to earnings per basic share, and it also looks similar to revenue. To revenue, again, we're giving another point to Bull Solo. So Bull. All right, so here I feel a strong Dark Force presence here, and we can see why. I can see Darth Bear gaining some strength here. So here we can see accounts receivables versus revenue. So accounts receivable, like I mentioned before, accounts receivable is when this company sells a product on a credit, it takes time for this company to receive its money, right? When you pay off, like for example, when you pay something based on a credit card, you sometimes consumers don't usually pay it off sometimes right off the bat. They pay it over monthly increments, and this is exactly what accounts receivables happens. So a company sells a product, a person purchases it on a credit, so then they collect the money on a monthly increment. That's definitely okay to do. It's okay for a company to do that. So here we're going to take a look at the trailing 12 months, and what you don't want to see is exactly what we see here, a huge jump in accounts receivables versus percent of sales. So I want to take a look at trailing 12 months because this is a lot better than taking a look at quarterly, because at quarterly, it doesn't give you the full pictures. So here, right, this company's total account receivables percentage of sales is right now 22.69%. and it has been increasing dramatically. We can see, right, it normally topped off at 18% or so. We can see it topped off at 18%, and it will fluctuate between 18 to like 10%. But in the past few quarters, it actually broke that line, and it has been increasing. And this is something you do not want to see. And Darth Bear here is giving us the evil laugh, and he knows he is about to get a point right now. This is something that investors should definitely take a look at, and we have to see how much more this is increasing. Even though right now it's not a bad thing because this company is still collecting a positive net cash flow from operations. It is something that eventually the money that is just going to be coming in, if it keeps going, it's just going to be credit, and that's definitely not a good thing to see. We're going to take a look now at payables and revenue. So like I mentioned, right, payables is what this company needs to pay to its suppliers. And we can see off right off the bat, this is pretty much on average of where it sits, right? It sits between its 15%. There has been no dramatic jumps, no dramatic craziness, so no one gets a point here. But Darth Bear finally got a point for it. And now here next, I just wanted to show you guys, right, account receivables. So next we see that my graph here to the right is days sales outstanding. So days sales outstanding is how long this company takes to collect its money from its payment. So right, sometimes like I mentioned, it's a monthly increment. So normally it would take this company somewhere between it fluctuates between 60 to about 40 days, and that's where the range would be. So between 60 to 40 days, and that's okay. But we can see the past few quarters, it just keeps going up. And this now is at 66 days. And this quarter is at 76 days, where it's taking this company 76 days to collect money on its product sold. And like I said, that's definitely not a good thing. Imagine if it keeps going up and going up. This company is just going to take longer and longer to collect its money from its product sold. So this is something that's definitely something to take a look at for investors. It's something to keep an eye out for future quarters. Darth Bear is definitely happy right now that he did not get a shutout, and he at least has a point for now. All right, so the final website, the final sheet we're gonna take a look at is just metrics of the company, and here, these are the ones I definitely try to take a look at. And first, it's gonna be debt to equity ratio. So debt to equity ratio is exactly what it means: is debt divided by total equity. Normally, you want this to be below 1. The reason you want this to be below 1, since it's debt divided by equity, you want equity to be higher than what the company has in debt. But for a growing company, sometimes that's not the case. You usually have debt to be higher. But this is pretty good to see this downtrend of debt to equity ratio. So this means two things. This could mean two things. The first thing is debt is being paid off. We see that this has. The second thing, it means that equity is increasing. We have seen that this is happening as well. So are both two good things that's happening to AMD. And again, Bull Solo is still killing the game, so he gets another point here. Next, we want to take a look at current ratio. So current ratio is our current assets divided by current liabilities. Again, this time you want current ratios to be above 1. You want this company to have more current assets. So current assets are assets that can be liquidized pretty easily, and current liabilities are liabilities that need to be paid off in the next 12 months. So this company right now has a 2.0 current ratio. So again, that's a good thing. That means that this company has double the current assets to its current liabilities. So for that reason, Bull Solo again getting another point. AMD is definitely not the same company it used to be. This debt to the equity ratio has gone. Current ratio is still pretty good. This company is able to be strong every quarter. It doesn't have to depend on outside sources to be able to pay off its current liabilities. Finally, we have gross margins and profit margins. So gross margins has been pretty flat around that 40%. We can see it definitely fluctuates between 30 to 40%. But this is where it's at, right? Is we can see it has an uptrend. And again, for another reason, Bull Solo gets a point. Profit margins, on the other hand, where I think profit margins is definitely more important. Profit margins is exactly what this company keeps afterwards. So profit margins is not looking that good. This company has a profit margin of 1.3%. That is pretty sad. This company if this company had money and did absolutely nothing with it, this company, let's just put it like this. Let's just put it like this, 1.3%. A company can collect better profits by having it in the bank instead of doing what it does right now, right? So 1.3% is nothing. And for that, we know who gets a point. Darth Bear. Darkseid did not let him go out without a fight. So that's it for the video, guys. I hope you enjoyed it. I hope you enjoyed my pals, Bull Solo and Darth Bear. Or is this Bull Solo? And this is Darth Bear. Yep, I always gotta confuse. I should put pictures right in front of me so I know which one's Bull Solo and which one's Darth Bear. And like that, I don't have to worry about pointing at the wrong person. But yeah, these guys help me keep track of what's happening, and it helps out so much. Right now, I'm only taking a look at top companies right now, so we can see sometimes that Bull Solo is definitely taking the lead right now. But I hope, let me know what you guys think about them. This is something that I just started doing. It's just a way for me to keep track on how the company is doing. So I hope you guys enjoy them. Let me know what you guys think. Post in the comment, give me a thumbs up, and subscribe. Take care, guys. See you next time, and have a good night.